Welcome everyone. Today we're discussing an important shift in perspective. Accountants were never meant to be just tax filers. Ask most business owners what their accountant does, and the answer is surprisingly consistent. They file my tax return, sometimes once a year, sometimes every quarter, occasionally every month. Then ask a second question. Who helps you understand your numbers? That's usually where the conversation changes. Many business owners have bookkeeping, they have accounting software, they receive financial statements, yet very few regularly review cash flow, profitability, operational performance, financial risks, forecasting business trends. The reports exist, the conversations don't. Somewhere along the way, accounting became associated almost entirely with tax compliance, and in doing so, the profession lost much of the value it was designed to provide. Accounting was never intended to end with a tax return. Tax returns are important. Financial statements are important. Compliance matters. But compliance has never been the ultimate purpose of accounting. The real purpose has always been helping business owners understand the financial position of their business so they can make informed decisions. Questions such as, are we becoming more profitable? Why is cash flow tightening? Which services generate the strongest margins? Can we afford another employee? Is expansion financially realistic? What risks are beginning to emerge? Those are accounting questions. Unfortunately, many businesses only ask accounting questions when a tax deadline arrives. Good bookkeeping explains what happened. Bookkeeping records transactions. It organizes financial information. It produces reliable records. Without good bookkeeping, everything else becomes more difficult. Bookkeeping answers one question: what happened? It is the foundation. But foundations are not the finished building. Financial reporting explains why it happened. Financial statements provide context. They identify trends, they highlight changes, they compare performance. Good financial reporting answers a second question: why did it happen? Why are margins declining? Why is cash flow changing? Why are expenses increasing? Why is profitability improving? Those answers transform information into understanding. Practical example first. Business situation. A professional services firm consistently received monthly financial statements. Common challenge: management rarely reviewed them beyond confirming revenue. Important changes in profitability and cash flow remained unnoticed for several months. Correct approach: monthly management meetings were introduced to review financial reports alongside operational performance. Business lesson: reports create value only when they support meaningful business discussions. Advisory explains what should happen next. This is where accounting creates its greatest value. Advisory helps business owners decide: should we hire? Should we increase prices? Should we expand? Should we finance equipment? Should we change compensation? Should we improve cash flow? Advisory answers the third question: what should happen next? That is where accounting moves beyond compliance. That is where accountants become trusted business partners. Practical example. 2. Business situation. A growing construction company relied almost entirely on year-end meetings with its accountant. Common challenge: most discussions focused on completed transactions rather than future decisions. Correct approach: quarterly advisory meetings were introduced covering profitability, forecasting, tax planning, pricing, and operational performance. Business lesson: accounting creates significantly more value when it supports future decisions instead of simply documenting the past. Business owners need financial clarity. Modern businesses generate enormous amounts of information: accounting software, dashboards, KPIs, reports, analytics. The problem usually isn't missing information. The problem is understanding what the information means. Financial clarity helps business owners distinguish important trends, emerging risks, growth opportunities, operational weaknesses, financial priorities. That clarity improves leadership. Practical example. 3. Business situation. A retail business experienced record annual sales. Common challenge: leadership believed the business was performing exceptionally well because revenue continued increasing. Correct approach: profitability, inventory turnover, cash flow, and working capital were reviewed together. Management discovered revenue had increased while margins had steadily declined. Business lesson: revenue alone rarely tells the complete story. Financial clarity does. The profession should be reclaimed. Accountants are trained to do far more than prepare tax returns. They understand financial systems, reporting, profitability, cash flow, taxation, forecasting, business strategy. Business owners deserve access to that expertise throughout the year, not only during tax season. Accounting should help businesses reduce uncertainty, improve decisions, strengthen financial foundations, support sustainable growth. That's what advisory looks like. Practical case studies. Practical case study. 1. Business situation. A family-owned manufacturing business viewed its accountant primarily as someone who prepared annual tax returns. Challenge: financial statements were produced every year but rarely used to guide operational decisions. Cash flow issues, declining margins, and inventory inefficiencies gradually developed without being identified early. Solution: the business introduced monthly financial reviews, KPI reporting, forecasting, and quarterly advisory meetings. Outcome: management identified several operational improvements, strengthened cash flow, increased profitability, and became significantly more confident when making strategic decisions. Key lesson: accounting becomes transformational when financial information drives business decisions rather than simply satisfying compliance requirements. Practical case study. 2nd. Business situation. A consulting firm believed it had excellent accounting because every tax deadline was met. Challenge: leadership lacked meaningful financial visibility between filing periods. Business decisions relied largely on intuition. Solution: management reporting, cash flow forecasting, profitability analysis, and regular advisory meetings were integrated into the accounting process. Outcome: decision-making improved, financial confidence increased. Leadership shifted from reacting to problems to planning proactively. Key lesson: the greatest value of accounting isn't filing tax returns. It's helping business owners build stronger businesses through better financial decisions. Common mistakes to avoid. 1. Treating your accountant as someone you only contact at tax time. Many business owners don't speak to their accountant until a filing deadline approaches. By then, many important financial decisions have already been made. Avoid this by scheduling regular meetings throughout the year to review profitability, cash flow, forecasting, and upcoming business decisions. 2. Believing financial statements are only for compliance. Many businesses prepare financial statements because lenders, tax authorities, or investors require them. The reports are filed away and rarely reviewed again. Avoid this by using financial statements as management tools rather than compliance documents. Every report should answer a business question. 3. Confusing bookkeeping with financial management. Bookkeeping records financial activity. Financial management interprets that information. Many businesses stop after bookkeeping. Avoid this by reviewing monthly financial performance and asking what decisions should change because of the numbers. 4. Managing the business using revenue alone. Revenue is often the first number owners look at. Unfortunately, revenue alone rarely explains financial performance. Avoid this by reviewing cash flow, gross profit, net profit, working capital, KPIs, and forecasts. Those numbers usually provide far better business insight. 5. Waiting until problems become visible. Many business owners identify financial issues only after cash flow becomes tight, profitability declines, taxes become difficult, or financing is required. Avoid this by building regular financial review processes that identify trends before they become expensive problems. Frequently asked questions. 1. Isn't preparing tax returns the accountant's primary responsibility? Preparing tax returns is an important responsibility. Helping business owners understand financial information and make better decisions is where accounting often creates its greatest long-term value. 2. How often should business owners meet with their accountant? Most growing businesses benefit from quarterly advisory meetings supported by monthly financial reporting. 3. What's the difference between bookkeeping and advisory? Bookkeeping records transactions. Financial reporting explains what changed. Advisory helps determine what should happen next. 4. Why do many business owners ignore financial statements? Often because the reports are presented without interpretation. Numbers alone rarely improve businesses. Understanding those numbers does. 5. What should every monthly financial review include? Profit and loss, balance sheet, cash flow, gross margins, accounts receivable, forecasting, key performance indicators. 6. What creates financial clarity? Reliable bookkeeping, meaningful reporting, thoughtful interpretation, strategic conversations. Together, they help leadership make better decisions. 7. Why is advisory becoming more valuable? Technology continues automating compliance work. Business owners increasingly need professionals who can interpret information, identify risks, and support better decisions. 8. What's the greatest value an accountant provides? Helping business owners understand what the numbers mean and how those numbers should influence future decisions. Action plan. Immediate actions. Ask yourself what your accountant currently does for your business. Review your most recent financial statements. Identify 3 important business decisions that would benefit from better financial information. Next 30 days, schedule a business planning meeting with your accountant. Begin reviewing financial reports every month. Identify key performance indicators that support management decisions. Long-term strategy. Build an ongoing advisory relationship instead of relying solely on annual compliance. Integrate forecasting, profitability reviews, and cash flow planning into management meetings. Use accounting as a leadership tool, not simply a reporting requirement. Key takeaways. Accounting creates its greatest value through better business decisions. Bookkeeping explains what happened. Financial reporting explains why it happened. Advisory helps determine what should happen next. Financial clarity strengthens leadership, profitability, and sustainable growth. Further reading: Financial Clarity, Why Better Decisions Start with Better Information. Discover how reliable financial reporting improves business leadership. Good accountants fix problems. Great accounts prevent them. Learn why proactive advisory often creates more value than reactive compliance. Why having more reports doesn't always create better business decisions. Understand how meaningful financial visibility differs from simply producing more reports. Tax and Financial Clarity Assessment. Does your accountant simply prepare tax returns or help you build a stronger business? Complete the Tax and Financial Clarity Assessment to evaluate your financial reporting, cash flow visibility, profitability analysis, forecasting, tax planning, and decision-making framework. Discover whether your accounting process is creating compliance or creating competitive advantage.